Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high net worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
All right, Andy. We're going through the interview process with a handful of great candidates right now. We've had a lot of conversations over the last few weeks with people with all different kinds of backgrounds. Some of these interviews we've done together and then others we haven't. So go ahead and tell everyone what your favorite interview question is.
Well, I just asked someone today what's their favorite active ETF, and I let them know that there was a right answer to that question. I'll let other people figure it out.
Okay.
But one thing you
Compliance, I love
may...
that.
Oh, I know. We're already getting that cut from the
Moving on.
rundown 5 seconds in. Yeah. But no. Something you may not know about me, or some people may not know about me, is that in addition to my economics studies in college, I also studied psychology. I actually took an industrial and organizational psychology class
Okay.
where they made the point that interviews are actually like pretty poor predictors of job success.
Oh, great.
And the one of the best things that you can do is actually come up with like some sort of a survey that gets you where you want to like basically make a psychological profile of who would be a good fit for this role, and then have like a survey that kind of gets at those themes, and then that's how you find people who will actually succeed at that role, not just someone who's like a smooth talker in an interview. So I thought it was really fascinating. So actually, part of our interview process is that we actually have people take a personality assessment. And we
Right.
kind of have an idea in our heads of like what a good fit would look like from that, and then we use that to evaluate it. So the question I always ask people after they've taken this test, because they get it too, they get the feedback, and I say, hey, do you think this accurately described you, right? What parts do you think it got right? What parts do you think it got wrong? And I kind of love going down that psychological angle.
Yeah. Yeah, it is really neat. It's amazing the tools that are available and they continue to become available to do this type of screening. So I'm with you on that. And I know you like always print out the interview questionnaire where they tailor psychological warfare questions to dip into everyone's psyche and, really like drive at their weaknesses. And
When I was a high school swim and dive coach, and the kids would find out that I had like a psychology degree, they would get real skeptical of me real fast. They're like,
the kids are
"You're ma-
smart.
you're manipulated me."
Yeah, kids are smarter
Well,
than you give them credit for.
what's your interview question?
Well, I'm not gonna toot my own horn too much. I came up with one on the fly the other day that I asked a question. I was like, "This is a good question." um, well, I somehow stumbled upon the path of asking someone, kind of laying out the theme that in our role as advisors, we have to use a lot of creative brainwaves in what we do, right? Like there's
Yeah.
art and, kind of science and art to what we do. A lot of the art is creative thinking and trying to piece different, aspects of the puzzle together. So I had asked, hey, give me an example of, times at work or in your personal life where you've had to be creative and what's your creative process and, what kind of fulfillment do you get out of being creative? Yeah, as a music junkie, it's easy for me to answer that question, but I'm always anxious to hear what people have to say about, kind of having a blank canvas with a client and being able to piece together all of your knowledge to build a plan is really exciting. Not nearly as technical or as uh, academic as your approach with the psychological profiling, but
Yeah, it's
interesting
like the
nonetheless.
anti-creative way to approach it versus
Yeah,
versus your
yeah,
approach.
but
Yeah.
psychology is huge in investing. It's a huge part of markets and how they move. And as an investor, whether you're saving or living off your portfolio, psychology is and our biases are an integral part of our investment and our planning experience. So Let's segue this into talking about some behavioral biases that we have as investors. We can maybe go through some examples of like
Sure.
what are the mental hurdles we run into as investors when trying to stay active in the markets and fully committed to our portfolios.
Yeah, so I created a list of, I think, a good group of biases. There's many, many, many biases out there, as you can imagine. One thing I want to get at before we like get into that list though is like, I feel like behavioral finance, which is really what we're talking about here, like 1.0 was like, well, here's a whole list of biases, right? Like I kind of had this unique perspective where I was an economics major but also a psychology major, and like economics kind of creates the straw man of economic man, right? This is like a purely rational creature that's always going to do the cost benefit analysis and come to the conclusion for what makes them better off and maybe makes society better off, depends on the problem, right? But like there's always this super rational being. And then psychology
Just
is sort
like
of
my
like the
wife
study.
shopping on Amazon, right?
Is that girl math right there? And then like psychology is like the study of like why people don't behave like economic man, right? Like they
Right.
don't make those choices that, if you do like a, game theory type framework where, the optimal outcome like isn't necessarily always what happens, right? So it's kind of like why do we mess it up? And so like behavioral finance 1.0 was all about talking about there's all these biases, this is why we're irrational. And I feel like it's almost framed in a way of like, oh, look at people making all these dumb choices, right? But I really
Yeah.
don't think that's what it is. And I think behavioral finance 2.0 has kind of like evolved to this thing where it's kind of all about like empathy and understanding. And we can get there if we want to. But I do think there's value in looking at the behavioral biases or in at least understanding them. And, we're sitting here, like we started this show because we're financial advisors who work with clients all the time. And, people are wondering the same types of questions. And so we wanted a platform for kind of giving our answers on those. But when we come to these behavioral biases, we're not immune from these, right? Every
Not at all.
investor, whether you're
Right.
hiring, an advisor, or whether you are the advisor, right? Everyone has these biases, and it's something that all of us need to try to at least understand, so that we can maybe try to overcome them, or maybe try to accommodate them, or maybe at least understand what's going on under the hood, because it really does have like very real impacts on investor outcomes. So I think I've got like 7 biases here. We'll see. It's certainly not a comprehensive list, and you might have a few to add as well, Adam. But the one that I like to start with here is overconfidence bias.
Hmm.
And essentially
Tell
what
me
this
more.
is, it's our tendency to overestimate our own knowledge and skills and ability to predict market outcomes. And what I learn is like there's almost like a curve in terms of people's like education on this, right? So like as soon as you start to peel back the onion when it comes to investing, and you kind of like figure out, okay, so I need to invest in stocks, I can do it this way. Maybe you're setting 401k allocations, whatever, and like it goes well for a short period of time. You're like, I know everything there is to know about investing. I am Warren Buffett, right? And people can get really, really overconfident in their own abilities, and then they try to apply those lessons to like the next era in the market, and it could go horribly wrong, right? So I
So
see this a lot.
this is like the more you know, the more you know you don't know kind of thing, right? Like
Yeah,
you get
yeah.
less confident as your knowledge increases. Is that kind of what it
Right. When
is?
you're in like the early innings of your journey, it's so easy to feel super overconfident, like that you know everything. And then you kind of need to
Right.
have these like lessons that cut you down. So like you eventually get to a knowledge point where you're like, oh my gosh, there's so much more to know about this. I know next to nothing.
Yeah.
But really we're kind of like on the front end of that curve. We're like you're just beginning to figure it out, so you feel really, really good about it. I think some examples for this are like people who hit it big on an investment like Nvidia, right? Or maybe it was like Bitcoin or the ARK funds, right? They were just getting into this. They started dabbling. It went really, really, really well for them. And so they felt invincible. And so what you see all the time, though, is like people will then start to over allocate to these things that they feel very strongly about. And they'll try to apply these lessons that worked for a very specific investment at a very specific time more broadly. And it can set them up for failure long term,
Well,
right?
and
So I
I
think
see
this,
this with like talking to other advisors too and
oh, yeah.
professional money managers. It almost feels like it gets easier when you're investing other people's money to act like you know everything or have that air of overconfidence, because hey, someone's hired me to do this. I'm really good. I must know what's happening next. I must have an edge over everyone else. But the really, really good long-term investors, it's fair to say, have, that ego is, I'm not gonna say ego, but like that level of humbleness is there on they would all tell you that they don't tell you with 100% certainty what they think is going to happen. They know they might give a framework, but they know that things change.
Oh yeah. Yeah, absolutely. So I think like to me when it comes to overconfidence, I think just, know that it's a possibility that if you feel really good about your abilities in picking certain investments, then like maybe take a deep breath and try to figure out, why that worked in the past. And a really good exercise that actually Daniel Kahneman, one of these Nobel laureates, one of the founders of behavioral finance, suggested doing is before you make a significant investment, think about like imagine that it's failed in the future and then kind of like work backwards from there to kind of identify, okay, why would this have failed, right? So it kind of forces you to think about, okay, like, I bought Nvidia, it did really well. I'm going to buy this, small Chinese semiconductor company because I think it's next Nvidia. Now imagine that it fails in 5 years and try to like work backwards to figure out, why it failed. I think that's a really interesting exercise and we can hopefully help combat some of these tendencies towards overconfidence.
I like it. Give me
Did you know
another
that
one.
did you know that 73% of people think that they're good drivers?
Oh,
Better
you
than
know
average
what? I do
drivers?
know. Yeah, the average driver study is hilarious. So actually, when I used to do dinner seminars, I would actually start early on in the presentation. I would ask the room, like, who thinks they're an above average driver, in reference to that study. And it's
Yeah.
hilarious how many people would raise their hand.
Oh
And
yeah.
I
Everyone's a
said,
better than average driver, unless they're from Maryland.
yeah, or New Jersey. And they would say, yeah, I would, ask the same question. It's like, who thinks they're above average investor? And it's the same psychology. I love it. Um,
Yeah.
okay, bias number two.
Bias number two here. This one we are, I mean, I think especially in the social media world where we are now, where we're all in our own little thought bubbles, confirmation bias is, quite frankly, maybe this is what I should have led with, right? Because I think this is something that is just so ingrained in the human experience. We basically just seek out information that confirms our prior beliefs, and we either avoid completely or discount any
Right.
disconfirming evidence that we're presented with, right? So we're all looking. So if we're bullish on the stock market, we're looking for all the reasons to continue to be bullish. Or, if we're bearish on a certain presidential candidate, right? We're looking for, every reason for the stock market to fall as a result, right? And it's just so easy to fall into these thought bubbles and just like completely discredit or ignore any disconfirming evidence whatsoever.
Yeah, looking at both sides of the argument is getting harder and harder. And with these algorithms now too on social media, or even these search engines, like you get fed what you look for. And it just seems like the only news you get pinged with is news that falls into what you've researched before and looked into. I would say I think that this is a good one for advisors too. Like I feel like I have to check myself on this. Like if I feel a certain way about something planning related or investment related, I tend to lead with trying to confirm what I'm feeling or what I think, but I'll always like
Yeah.
call time out and try and look at the other end of it and get counter arguments, which is hard to do. But yeah,
Getting a
that's even
lot of
harder to
this
navigate today.
I'm getting a lot of this right now, like directly from clients. And the question's always like, and these are people, I mean, we try not to veer too much into politics here, but these are just, client questions that we're getting. We have clients from across the political spectrum. So as you can imagine, people's opinions vary drastically depending on who's in office. And so we have
Sure.
people who are very concerned about the direction of the country and the perceived kind of chaos geopolitically that we're in right now. And for them, it's really hard to square that against what's going on with the stock market, right? And the stock market continues to make all-time highs, right? There was a little bit of volatility earlier this year in April, but it's rebounded quite a bit. And I think a big reason why people are really concerned right now, because I think if you look at a lot of objective measures, like the inflation impacts haven't been as bad. Corporate earnings continue to come in and surpass expectations. Look at GDP growth, right? The US economy is growing very fast. These are the things that ultimately drive stock prices. But I think people are kind of like stuck in this confirmation bias where they could just kind of like, my preferred candidate or party or whatever isn't in office. And so I think things are going to be bad. And by the way, this happened too when Biden was president and Obama. So this is just universal across the board. I'm
Yeah,
not trying to make a
clients send
value
you
judgment on
articles.
anything.
Clients
Yeah,
send you articles like why the market is gonna drop 50% because of crazy Trump, or why inflation's going to
sure.
50% because of crazy Biden. It's
Yeah,
they're going, because we go to political, and politics is the best example of this. Like we all go to, there's no middle team anymore, right? We all go to websites that confirm our political beliefs,
hmm
and
and the social
yeah,
media algorithms drive you there, right?
yep, yeah, that's a hard
So
one.
it just so people are finding it hard to like there's this I've been using this term cognitive dissonance a lot recently in my calls with clients because it kind of feels that way to them. And the thing that we try to like get them to do is okay, well, just one strategy I have, just for trying to combat this bias in particular is kind of deliberately seek opposing viewpoints, right? And try to seek those viewpoints with an open mind. So if you think that things are bad and like the shoe's about to drop in the stock market, I would just encourage you to try to make the argument and find people who are making the argument for why, stocks will continue to do well, why, like economic catastrophe is not right around the corner, right? I think that helps to overcome this one in particular.
Like it. So be proactive about where you're looking for information.
Yeah, yeah, exactly. All right, I'm going to move on to the next one here. So loss aversion. This one is, you have to keep in mind, where we came from, right? Like humans did not evolve, that we did not evolve from, this. I look outside my window here and I see skyscrapers and tall buildings and like, this like modern day, ecosystem that we're in where evidence and everything comes at you really quickly. Like we evolved from, like hunter gatherers, cavemen, where like when we saw danger, like you had to run, right? Like you saw a saber, probably not a saber-toothed tiger, but you saw some sort of threat out there, a bear, what have you, like you better be on your
Right.
high horse, right? So loss aversion is this bias that says that we feel losses more than we enjoy gains. And in fact,
Hmm.
there was some seminal research on this from the psychologist Daniel Kahneman I talked about earlier, and also his running mate Amos Tversky, and they found that it's about 2.5 times the emotional impact for losses versus gains, right? And so where I see this impact investors is they are quick to sell when they're at a gain, right? Because they want to lock in those gains, but they'll hold on to losing investments for a long time, just waiting for them to come back, right? Just because it's they're feeling that loss quite a bit more, and so it's like they don't want to experience that loss and they want it to come back. So this loss aversion thing, I think is very real. And it's why like stock market's up 4 out of every 5 years, right? Like we should all be like really gung ho about investing, but for some people it can be really scary because that 1 out of 5 years feels so bad that they really latch onto it.
Yeah, that's a great one. How many times have we heard from a client when we're trying to rebalance a portfolio or make some sort of investment decision? Oh, well, I'll sell that when it gets, well, this is probably two biases in one. I don't want to front run it, but like, hey, I'll sell that when it gets back to what I bought it for, right? You're anchoring a little bit there too, but like you're saying, hey, I don't want to lock in my loss.
Yeah,
I want to end on a positive note.
yeah, and exactly, and it's like, well, keep in mind, not every investment's going to do well, right? So you buy a stock, it goes down 25%. It might be time to get out of that stock and get into something else that has better prospects. But this, wanting to continue to hold it, they call it the disposition effect. That's the fancy jargon term. But wanting to hold it until it gets break even though you have other investments that might get back there quicker, that can be
Right.
that can be really tough for people.
Yeah, fear is real, and loss aversion in investment management is definitely a force. So that's a great one. What's next?
So we were out in Yellowstone, Adam. While we were there, there was actually a bear attack on a hiker.
I survived.
But so if you go back, would you, knowing that, would you go back out there and hike around in the great
Well,
outdoors?
you're asking the wrong person. My answer, well, I didn't venture as far into the woods as this individual did. So I planned ahead of time. But if I was thinking about doing it and then this just happened like the same weekend, even though the odds haven't changed or the risk is still low, I would not. No. That's the
Yeah,
difference between you and me.
well, the last bear attack before this in Yellowstone was 2001, right? But I get it, totally get it that this makes it feel really, really scary. And the reason for that is this bias called recency bias. And basically, it's the tendency to give greater weight to things that have just recently happened and then extrapolate into the future. So, one area for investors where I'm seeing this a lot right now is on the topic of inflation. I think we all know 2022 happened. It was really the bear market for everything, right? Stocks were down, bonds were down, and it was because inflation kept coming in hotter than expected. And so the Fed had to be very aggressive about raising rates. And so now, fast forward to 2025, and we're getting more inflation news. But inflation's no longer the emergency that it was, and even if it does, rise, I think most economists kind of expect it to be like a one-time shock before it comes back and normalizes again. But I think in people's minds, they're still thinking about 2022 and how this inflation story just kept on going over and over and over again, right? And so it makes inflation feel maybe scarier than it should be for a lot of investors. The same thing happened during COVID. Now we're looking for every little, virus or bug or pandemic happened in '08. Everyone was looking for the next housing crisis, right? It's just whatever has recently happened, people then really lock into that as being the risk for stocks. And really, if the stock market sees a risk, it's probably not going to be the thing that knocks it off balance. It's going to be the out of left field thing that no one sees coming, right? So I
Yeah.
think this recency bias thing is also something that I think a lot of people know this on an intuitive level, but really have a hard time reflecting on it.
And we picked that up in client conversations, right? If the market has gone up, it means it's going up forever. And if the market's going down, it means it's going down forever. And even though there's millions of inputs or some infinite number of inputs that can drive the markets or the economy in any direction, and they all behave differently and the dynamics are different through time, it feels like whatever's happening or has just happened is the new thing. And that's why the most dangerous words in the investor's
This
dictionary
time it's
are
different.
this time is different.
This time
It's
it's
like
different. Yeah.
this is the new economy, the new normal. Like these are the stocks that are just always going to go up, or this is 5% inflation is the new normal. That's just what we have to live with because of X, Y, Z. That's a dangerous game to play when making money decisions. So I like that one, and it's
Yeah,
real.
sell everything, buy Bitcoin. Let's go. I do think it's
Yeah.
useful here. Give some strategies to kind of counteract it too, where the longer term perspective you can take, usually the better off you are. And that can be really hard to do in the moment, but I think that's where a good advisor will bring value and they'll share, okay, well, I know this is happening right now, but here's the 10-year, 30-year, longer term perspective on this topic. And I think also like, you have an asset allocation mix for your portfolio for a reason. And sticking to that within certain guardrails, I think is really powerful to help combat this bias. So to kind of set yourself up to structurally succeed by having a specified asset allocation and then stick with it through thick and thin, rebalance back to it when things get out of whack. I think these are really good strategies for dealing with this one in particular.
Yeah, especially when you're trying to convince anybody to hold any form of value stocks or bonds.
So another one that you actually mentioned already, we'll bring it back up here, the anchoring bias. So this is one of my favorite things. I think there was I don't I'm gonna get the exact numbers wrong, but it's like if you ask someone, what do you think is the population of Chicago? And you say, and you give them like a number to anchor on, like 100,000 people, they'll systematically underestimate it. But if you give them like a very big number, like 100 million people, then they'll systematically overestimate what the population of Chicago is. So I think this one is really interesting when it comes to investors because we oftentimes whatever starting number kind of we start with everyone has a tendency just to anchor in on that number, and they evaluate how their performance is doing, whether it's above or below that number, when that's not necessarily the rational way to think about it.
Yeah, I'm not selling my Apple stock unless it gets back to X dollars per share. How many times have we heard that? I mean, that's it in a nutshell. And I think a big thing with anchoring is you miss opportunity cost. You don't
Sure.
factor opportunity cost into that. It's like while we're waiting for this stock or this investment get back to where it was, other things might be doing exceptionally better at the same time.
And
Um,
I see it also with people who have cash on the sidelines, right? Like
yeah,
they'll anchor to like, oh well, just last year the stock market was at 5,000, now it's over 6,000, or whatever the number is, and they'll anchor to that lower number, hoping it gets back there, and then it never does, right? Like if
yeah,
you started, S&P 500, what 6,500 right now in 1990, the year I was born, it was 250. Right. So if I started investing, and to me, the S&P is like 250, now it's like 6,500. It's gonna be really hard for me to get in. That's kind of an extreme example of this, but yeah, like that anchoring thing can be really powerful. So I think you just kind of have to ask yourself, like, when it comes to like, is this a fair price? Well, are you considering what it used to be in the past, and those days are gone, or is it actually like a rational analysis that you're doing?
yeah. Go on.
Do you know what FOMO means?
Fear of missing out. I am hip. I'm in with the ever uh, the ever evolving list of acronyms that we need to keep track of these days.
Yeah, that's right. That's right. So this one is sort of this can really happen in investing. It's about having like a herd mentality, right? So it's this bias for people to follow and copy the actions of a larger group of people, right?
Never
When it
heard of
comes
it.
to whatever the trade is, right? So I think the really famous example of this, do you recall like the meme stock mania, where like it was everyone was locked down, and like AMC, the movie theater chain stock, was going crazy, even though no one can go out to the movies, or like GameStop, right? Like this company who's like essentially the Blockbuster for video games, or really they're selling used video games or whatever. Like these days, you don't buy physical video games; it's just like a download code right onto your PS whatever or Xbox whatever, right? Like, and but GameStop was the stock that was going through the roof because everyone on Reddit thought it'd be fun to do it, right? So like this is, I think, a really interesting one, and it can really explain some really irrational times in the stock market.
Yeah, it's and this is especially hard because this is what when you turn on CNBC, I think the producers there feed into this, right?
Oh
There's a
yeah.
theme of the day in the stock market, and there's a way that the herd is moving, and they bring people on and they push content and other in the financial press push content to perpetuate that even more.
Yeah, you see this a lot when, people are overly bullish or overly bearish, right? And you'll see that narrative be pushed. I think it's really important, that Warren Buffett quote about being fearful when others are greedy and greedy when others are fearful, right? Like that's a way to maybe try to
Yeah.
push back against the hurting. Like if you think everyone's going to cash when the market's selling out, it's really scary to say invest in. Well, maybe that's when you should be pushing the chips in.
Yeah, we'll turn on the financial news next time we have a 10% correction. Like today, everyone's,
Oh, sky is
pretty
falling, right?
feels pretty good about things, but second we hit our next 10% correction, turn it on and you'll have all these people that are like, "Oh yeah, we knew this was coming and this is just the new trend, the new market that we're in." That's a good that's just the reality.
Yeah, absolutely. All right, I've got one more, and then
Okay.
if you've got any to add too, feel free. But I only have one more on my list here. It's something that I actually talk about quite a bit with clients, especially new clients when they come on board. But Adam, what I think you know the answer to this question. What percentage of the global stock market is made up of U.S. companies?
65%.
Yeah, 65%. It's actually gone up, I think since we first started working together. It used to be closer to 50-50. Now, what percentage of US investors do you think, I guess for US investors, I should say, what percentage of their portfolio is made up of US stocks?
95%.
Yeah, exactly. It's much higher. And by the way, this holds true for people across the globe. Like people in Australia own a disproportionate amount of Australian stock. people in Japan own a disproportionate amount of Japanese stock, right? This is something that is just really widespread, this idea of a home bias, right? And it's just the fact that we live in a certain country. There's a rational reason for it, I think. Like, we understand where we live really well. We understand the businesses that do business here and were founded here, right? So it's often like really comfortable to invest in those home markets. And so what I see people do all the time, especially when I'm looking at like new portfolios for clients who, haven't, had an advisor before, or maybe they were really focused on the US, where, they'll oftentimes come to us with zero exposure to overseas equities. But, if 65% of the stock market is the US, okay, so it makes sense to have more than 50-50. But that's a pretty big opportunity set that's just being excluded if you're not investing globally. And you've seen it this year where international stocks, both emerging markets and developed markets, have outperformed the US. And if you're only focused on the US, then you're missing out on that opportunity, right? So I think this idea of a home bias, what I'm trying to say here is I'm trying to give you permission to invest a little bit outside of what you're comfortable with. And the world is a big place, and there's lots of quality companies located elsewhere.
Yeah, we are always coaching clients through this one, and that's yeah, we see it. Luckily for U.S. investors, that's been a good bias to have the last
It
15
has
years.
been. This is an example of, so maybe this is a little bit overconfidence, a little bit of recency bias, right? You can see how
Yeah,
these things sort of interact with each
yeah,
other.
this is like the psychological, the behavioral finance chili here. We've got like all the biases tossed into one pot, and it's hard to get out of. But this has been a real one.
Yeah. Do you think I missed anything?
The only other one I thought of was endowment. It was it the endowment effect. I
Yeah.
might butcher this, where you've got like legacy positions in your portfolio, whether you inherited it or it was an old company stock, for a firm the company you used to work for. Um, but just holding on, or it's gifted to you by a family member.
It's
It's just holding on to a stock that for a reason that has nothing to do with the company or its future outlook, but continuing to hold it because of, personal emotional reasons.
Yeah, it's more valuable to you because you own it. But yeah, that's a really good one. Certainly has some impacts on decision making.
So I love that. We love talking to clients about these when they come up. I love your point earlier on about this being a real, like a real thing that we deal with as professionals too. No one is immune from these.
Yeah, no one's
They are,
immune.
yeah, it's like one of those things where like you can't fix it, but you can manage it. Management is the way to get through it.
Yeah, absolutely. Yeah, and I think you have to come to the conclusion on a lot of this stuff where if you're just aware that these biases exist in the first place, sometimes that can be enough to overcome them, because what you're feeling is very real. Like, especially, some of these things like recency bias, market sells off, you're fearful, right? Maybe now you're anchoring to a lower price point. You think things are going to keep going lower from there, right? It's very real, the experience. I think sometimes just having this knowledge that there are these predictable biases out there can go a long ways. Now, Adam, I know we had a one more topic here on the agenda, but we're running a little bit late on time. Plus, apparently my Wi-Fi is having some issues back here. So what I'm going to say is let's punt a very good question to next episode, which is, when should I think about opening a trust? And I'm just going to tease it right there.
Yes, let's talk trust. I love this one. This is one of the most frequently asked questions when it comes to estate planning. Do I need a trust? What kind of trust should I consider? And yeah, what are the pros and cons? Let's do it next week. Looking forward to it. Any other questions you all have, keep them coming. Long story short at Bernie.com.
See you next week.
This podcast featured Adam Newman and Amy Pratt of Bernie Wealth Management, which is a division of the Bernie Company, an investment advisory firm. Adam is managing partner and is chartered financial analyst, certified financial planner, master of taxation, and retirement income certified professional. And Andy is senior partner and director of investment strategy and is a chartered financial analyst and chartered alternative investment analyst. Long Story Short involves general discussions of a broad range of current financial topics related to financial planning, taxes, investment, and retirement. This content is for informational and educational purposes only and is not intended as personalized investment advice or recommendation. It does not take into account your financial situation. You'll need to consult with a qualified financial advisor or professional who is familiar with your specific circumstances. Investing involves risks, and past performance is not indicative of future results. The Bernie Company is an SEC-registered investment advisor. Registration with the SEC or any state securities authority does not apply to the Bernie Company or any of its principals or employees, possesses a particular level of skill or training in the investment advisory business or any other business. Bernie Company does not provide legal, tax, or accounting advice but offers it through third parties. Before making any financial decisions, clients should consult their legal and/or tax advisors.